Hi, my name's Tom O'Shea and I'd like to thank you for taking a minute to look at this short video on income protection insurance. It's designed to explain a little bit about the basics of income protection insurance and some of the things you need to consider when looking for a new policy. But firstly, I guess, we all have these plans going forward in life, and they typically revolve around things like retiring at a particular age and doing some fantastic things, paying off the mortgage, sending the kids to a good school, but they are all heavily reliant on our ability to earn an income. So effectively, by not having an income protection policy or not having an appropriate income protection policy in place, these are the things that you're putting at risk. So it's really crucial to consider income protection for anyone who relies on an income. So what it does, income protection insurance basically pays you a regular income in the event that you can't work because of a health concern. So you might have broken your leg, you might have hurt your back, you might be off work because you've got cancer or had a heart attack. And in these scenarios where your work income doesn't come in, income protection policies are designed to replace most of your income. So the options you have are very varied, and they'll affect the cost greatly as well. Some of the main things you need to consider, and by all means this list is not exhaustive, but probably the first one is how much cover you have. So how much money do you need to see coming in the event that your income stops, your normal employment or self-employed income stops? Typically insurers will offer you around about 75% as a maximum. Another one is how long you're happy to go without an income for. So those of you who have a nice chunk of money in the bank, who have a spouse who works and earns an income, who have a lot of holiday pay, those types of things will possibly mean that you can wait a little bit longer for the insurance to kick in, making the policy cheaper. If you don't have those things in place, you may need the policy to kick in sooner, and therefore it'll be a little bit more expensive. You also need to consider the benefit period, so how long the policy will pay you out for. Other things that you need to consider are, do you have a guaranteed policy or not? So having a guarantee in a policy will typically cost you a little bit more, but it just means that you know exactly what you're going to get in the event that you make a claim, rather than your entitlement having some relationship to what you're earning at time of claim. You need to consider affordability for you with your cash flow at the moment. So there are options of paying for it out of your pocket or paying for it from your super fund. If you pay for it from your super fund, obviously the main thing that you've got to understand is you are using your retirement savings to fund this insurance, so you're still paying for it. And there's differences between those two policies, and different tax impacts and things like that. You also need to consider what type of premium structure you want. So you typically have an option for a cheaper policy that will get more expensive with age, or one that's a bit more expensive to start off with that won't increase so much as time goes on. Your premium will also be affected by your age, what type of occupation you've got, your smoker status, your health history. So look, the important thing to understand is that it is crucial to have an income protection policy if you rely on your income coming in. It is possible to put them in place yourself, however it is difficult to get it right. So this is something that I do regularly. If you need help getting a policy in place, please feel free to contact me. But regardless, I hope this video provided you with a little bit of helpful information. Thank you very much.